This is our second video on an introduction to taxes as it relates to investments. In our first video, we went through the U.S. federal income tax brackets for 2011, talked about the idea of personal exemptions and standard deductions and how they can lower your taxable income, as well as calculating total taxes, average taxes, and marginal tax brackets. Now what we're going to look at are some of the other specific investment implications. Now we needed to go through the tax brackets because our capital gains taxes and dividends taxes are tied to the idea of the tax brackets. Again, legal disclaimer, this is designed for educational information, kind of an academic overlook at investment taxes. This is not personal tax advice. If you are trying to figure out your personal tax situation, please consult a tax attorney for the best advice. First thing we're going to look at are capital gains taxes. Capital gains come about whenever you sell an investment. Oftentimes we think of capital gains with stocks, but it can be other investments, for more than what you paid for them. Now, capital gains are split into two time periods. There's long-term capital gains for investments that you've held for more than a year. Say you bought a stock 2 years ago and you sell it today, it's going to be classified as a long-term capital gain. Now, from the viewpoint of the IRS, long-term investors get better tax treatment. So if you hold a stock for more than a year, you're going to pay less taxes. Specifically, if you're in the tax bracket, and again, this is for 2011, so this is based on 2011 tax rates, and at least as of now, these rates are also effective for 2012. But taxes, the one thing you can always count on is tax situations are going to change. So no guarantees that those are still in effect if you're watching this video in 2012. But the tax rate for long-term capital gains, if you're in one of those two lower tax brackets, the 10% or 15% tax bracket, you don't have to pay any income taxes on capital gains, on long-term capital gains, stocks that you've held for more than a year. If you're in the 25% or higher tax brackets, you still have to pay taxes, but it's at a reduced rate. Only 15% of the capital gains are going to go to pay taxes. So if you made a $100 profit on your investment, 15 of it goes to the IRS, the other 85 belongs to you. Now, if you're more of a short-term investor, you tend to buy stocks, hold them for a few months. Now you've got short-term capital gains. The IRS does not look on short-term investments as favorably as it does long-term investments. Short-term investments are taxed as ordinary income. Remember, the lowest marginal tax bracket was 10%, so that's your lowest tax rate that you're going to face. The highest marginal tax bracket was as high as 35%, so you could end up paying 35% on your short-term capital gains. What this means is when you're close to the long-term, short-term holding period, you have a very strong incentive to hold it long enough to get past that 1 year. For most of us, more of our investments should be held long-term, assuming they're not in tax-sheltered accounts, so that's going to give us better tax treatment. If you're somebody that doesn't have your money in a tax-sheltered account like an IRA and you're trading frequently, you're probably spending more of your money in taxes than you'd be generating if you held on more long-term holdings. Now, while you have capital gains, you can also have capital losses. Initially, capital losses offset your capital gains. So in the course of the year, let's say I made 10 stock trades, some of them made money, some of them lost money, and let's say my total capital gains accounted for, let's say, $5,000. I also had some of those trades that lost money. Let's say on those I lost $2,000. Now my net capital gains is only $3,000. So that first $2,000 in capital losses offsets my capital gains. What if things turned out far worse? Let's say that my cap gains were only 2,000. My capital losses were 8,000. I had a really bad year. Now my net capital losses are $6,000. First 3,000 of those capital losses can be used to offset other income during that year. So let's say my taxable income before I looked at my capital gains and losses was $70,000. I can reduce that by 3,000, not the full 6,000 I lost. Maximum I can reduce my other income is 3,000. So if I had 70,000 in taxable income before this, I'd have 67,000 left over. The rest of that can be carried forward to future years. So next year I have 3,000 in capital losses already set up to start offsetting my capital gains for that year. Now, the IRS doesn't like people artificially using their tax losses. They don't want you to sell a stock today, record a capital loss so you can lower your taxable income this year, and then turn around and buy it the next day. So there's something called a wash sale rule that states if you sell a stock for a loss and repurchase it within a 30-day window, you can't record a capital loss at that time. Instead, what you would do is lower your initial purchase basis, taxable basis on the stock, and you'd be able to use that capital loss later when you sold the stock at a later point. But the wash sale rule says that you can't just sell stocks at the end of the tax year, turn around and rebuy them in order to get the capital loss. If you sell a stock, you have to have it sold and left sold for 30 days. After 30 days, you can buy it back and then use your capital loss without any problem. Dividends also have special tax rates. Historically, dividends were taxed as ordinary income, but about 10 years ago, dividends started receiving favorable tax status. And just like long-term capital gains, if you're in the 10 or 15% marginal tax bracket, you don't have to pay anything on your dividend taxes. If you're in a higher tax bracket, 25% or higher, you have to pay 15% on your dividends. Now, I should note that those are qualified dividends. There are a few rules that have to be met in order to qualify those dividends. However, most ordinary stock dividends, as long as you're not running some kind of dividend capture trading program, are going to qualify under the dividend tax rate. In general, usually your broker will send out a statement, tax statement, that will give you your dividends and will classify them as qualified dividends or unqualified dividends. Qualified dividends are what we're talking about here for the dividend tax rate. Again, most ordinary dividends from common stocks are going to qualify, but there are some exceptions. Interest income. Interest is taxed as ordinary income. There's no tax advantage for that investment income. Now, that does have some exception based on the type of interest it is. So, for instance, some interest income, such as municipal bonds, is typically not taxed at the federal level. So if you buy a municipal bond, typically you're not going to pay any income tax on that interest. However, if you buy a corporate bond or a treasury bond, then you are going to be taxed at the federal level on that interest income, just as if it was ordinary income. If you've got money from a CD or a savings account or some bank account that you're earning interest on, that's going to get taxed as ordinary income. So capital gains and dividends, or I should say long-term capital gains and dividends, have favorable tax status. Interest income does not, unless it happens to be a municipal bond, in which case typically that interest is not taxed at the federal level. Now, there are some other ways to reduce your tax burden on your investments. Traditional IRAs and Roth IRAs are individual retirement accounts that you can set up. There's a little bit of difference between the traditional IRA and the Roth IRA. The big difference is traditional IRAs, you get a front-loaded tax break In other words, if you invest $3,000 into a traditional IRA, the IRS is going to consider that not taxable income in the year you earn it. Let's say you make $40,000 this year, you invest $3,000 into a traditional IRA. As far as the IRS is concerned, you only made $37,000, so you get a tax break in the year of your contribution. While the money is in the IRA, it compounds tax-free. Any capital gains, interest, dividend income you earn while that money's in the IRA is not going to be taxed until you withdraw. Now, traditional IRAs, eligible withdrawals start at retirement, which the IRS considers available at 59 and a half, and you must start making withdrawals by 70 and a half for a traditional IRA. When you start making those withdrawals, the money that you withdraw is taxed as ordinary income. So every dollar that you take out of your traditional IRA is going to be taxed as ordinary income. The Roth IRA is more of a backloaded tax break. If you make $40,000 and you contribute $3,000 to a Roth IRA, you're not going to get a tax break for your contribution. The IRS is going to assume you still made $40,000 and tax you on that money, regardless of whether you spent the money on a trip to Las Vegas or you put the money into a Roth IRA. However, while the money's in the Roth IRA, just like the traditional IRA, it compounds tax-free. So any interest income, dividend income, capital gain income, whether it's long-term or short-term capital gains, no taxes paid as long as that money is within the Roth IRA. Once you hit retirement, again 59 and a half, you can start taking money out of your Roth IRA, and that money is tax-free, so there's no taxes paid on eligible withdrawals from an IRA. You don't get the tax break up front like you did with the traditional IRA, but now you don't have to worry about taxes when you take your money out. Which alternative is better? It depends on specific tax assumptions. What is your current tax rate? What is your tax rate going to be when you retire? How long the money has to compound? In many cases, the Roth IRA works out to be a better deal, but that's not going to be true 100% of the time. So it's going to depend on your specific tax assumptions. 401k plans are also tax sheltered accounts. They're similar to a traditional IRA, except they're run through your employer. Some employers offer a match with a 401k plan, some don't. But the idea is if your company offers, say, a 50% match, you contribute $1, they contribute 50 cents into your 401k plan, and that money is going to compound tax-free while it's in your plan. Also, you're not going to be taxed on that $1 you contributed in the year you make the contribution. Once you retire, just like the traditional IRA, and start pulling money out, then you're going to get taxed on that as ordinary income. Now, just a couple years ago, they introduced a Roth 401k plan. Depends on your employer whether or not those will be available to you or not, but a Roth 401k plan is structured more like a Roth IRA, except for the Roth 401k is run through your employer instead of set up independently. The traditional IRA and Roth IRA are both individual retirement accounts. You can contribute up to $5,000 per person per year, assuming you meet the income qualifications. And I'm not going to go through those in this video, but you can look those up online. $5,000 per person per year total, again, assuming you meet income qualifications. You can do that $2,000 in a Roth IRA, $3,000 in a traditional. You can do it $4,000 in a traditional, $1,000 in a Roth. You can put all $5,000 in a Roth or all $5,000 in a traditional, but you can split that $5,000 up as you see fit.